Good morning, everyone. Aren't we sick of this snow? And so,
Snow again tonight?
oh my, tonight or tomorrow?
Tonight and Saturday.
Oh my gosh. In the midst of all of this snow, I was supposed to present a paper at Villanova, and they canceled it because they had like a foot of snow, and they didn't know if they were going to get more snow. And as someone was telling me that there was some kind of major accident on the Pennsylvania Turnpike, so I guess it was a good thing I wasn't on my way to Villanova today. But in a way, I'm glad they didn't cancel class, because if they keep canceling classes, I don't think we're going to get through the semester. So, all right. So let's talk about engagement planning. So when we talked in the beginning, right, we talked about generally accepted auditing standards. And there were three components to generally accepted auditing standards, right? So we had responsibilities, we had the engagement, and then we had reporting, right? So a lot of what we've talked about so far up until this point has really dealt with the auditor, right? The characteristics of the auditor in terms of the responsibilities that the auditor has to conduct the engagement and instill confidence, public confidence, or third-party confidence in the work that they're doing and the audit opinion that they're providing. So as we're moving through to this phase, the second phase of the audit, we're going to look at the conduct of the audit, the engagement itself, the audit process. And so, those standards talk about due care in terms of planning. So planning is one of the initial steps in the audit process, right? If you don't plan, right, you're going to fail. Right, so if the auditor doesn't have a game plan going in, then they're not likely to conduct an effective audit. So we're going to talk today about what we mean by engagement planning and what the process is in engagement planning. And this engagement planning obviously is whether it's a new client or it's a continuing client. So each year you go to your client, you're still going to engage in this engagement planning process. You have to. Things change at the client, people change. You have new audit staff rolling on. If it's a publicly held company, you could have a partner, an engagement partner rolling on, and a new engagement partner rolling on. So obviously, what we're trying to do as auditors, or what auditors are trying to do, is they are issuing an opinion on the financial statement. So in order to issue an opinion on the financial statements, they have to have sufficient evidence. Right? That evidence has to be able to support their opinion. If you look at some of the deficiencies that the PCAOB has noted with respect to their audits, their investigation or examination of audits, what they're citing a lot of times when they're citing deficiencies is that the auditor's work does not support their opinion. So they don't, the opinion, if they're giving an unqualified opinion, right, which is a clean opinion, the work that they've collected to substantiate that opinion is deficient. And so this is the importance of engagement planning, is to obtain a real good understanding of your client. Remember, I said in the beginning that the audit approach is a risk-based approach. So a huge part of engagement planning is being able to identify or gather information, evidence to support your risk assessment. And next week we're going to talk about the audit risk model, and we'll talk about the components that's involved in that risk assessment process. So to obtain sufficient competent evidence, obviously most audits are not unlimited in their budget. A client is not going to say, look, just come on in here, do the audit, whatever it costs you, we'll pay you. Doesn't happen, right? So like anything, an auditor has to control the cost. You have to have reasonable costs. The client is not going to allow you to run away with costs. So you want to be able to keep your audit costs reasonable. Right? You have to be competitive as an audit firm, and also to avoid any misunderstandings with the client. So you'll see in the chapter they talk about the engagement letter. So the engagement letter is the contract between the client and the auditor. It lays out specifically what the auditor is going to do and what the client is going to do. So what schedules are the client going to provide? What personnel are they going to make available to the audit team so that the audit team can conduct the audit efficiently and effectively? Right? What's the timetable in providing that? When is the client expecting that the auditors will issue the audit report? And this is extremely important for publicly held clients, right? Because they have to file their 10K by a certain time, date. And so it's important that these dates are laid out in the engagement letter. Some pre-engagement activities that the audit firm will engage in is this idea of this client acceptance or continuance, right? So obviously if it's a new client, the partner or an engagement team has gone out to solicit this client, right? They bid on the client and now they have the client or the clients approach them and say, you know, we're looking for new auditors, we invite you to bid, right? So they have to determine, is this a client that we want to accept? So firms are not going to, especially the larger firms, they don't have to, for one thing, right, because they're so large, but they're not just going to accept clients, right? They're going to do a background check, they're going to talk to business people that the client or companies that that client has done business with, lawyers, bankers, right? If it's a publicly held company, they're going to look at the client's history with the SEC. They're going to do background checks on management, because what are they concerned about? What do you think the audit firm is concerned about before accepting a client? What's their concern? John?
That maybe they'll try to influence them, like they won't hide some information.
So that's a good way, and basically saying integrity, right? They're concerned about the integrity of the person or the clients that they get into business with, right? So if the client lacks integrity, what's the consequence to the auditor, do you think? If you're dealing with a client that lacks integrity. Yes, Ella. Right, they might not get all the information that they need to complete the audit. The information might be biased in some way, or the client might be, not very truthful. Victor.
The auditors sign off on the statements, and it's later found out that there's fraud, and the auditors look at it.
Right, they're concerned about their reputation. There's reputational effects of dealing or associating with certain clients. And also it's going to have an impact on your existing clients. Right, your existing clients, and you saw this in the early days of Enron, when Enron broke, right? That given the problems that existed at Enron, and also Andersen had a string of some significant audit failures with WorldCom, Enron, right? Clients started leaving Andersen, right? Not because Andersen had done anything wrong with their books, but it was the perception in the market. They didn't want to be associated with Andersen necessarily, because they didn't want to invite that scrutiny on their books and records, because they felt as though the market might look at them, or the SEC might look at them and say, okay, this is an Andersen client, now we're going to scrutinize this client a lot more. So they had a lot of clients leave them because of that reputational effect. So firms are very concerned about their reputation. We talked about legal liability, litigation, that whole deep pocket syndrome. So if you're associating with a client that lacks integrity, or you don't feel that that client has the highest amount of integrity, you're going to take pause and say, is this a client I really want to be associated with? Because what's the outcome? What if the client did, because obviously firms take on, there are clients out there where, certain members of management lack integrity, they're still getting an audit done, right? If they're a publicly held company, they have to have a firm, an audit, and a larger firm. Right? So what do you think the audit firm does to protect themselves in that situation? How might they protect themselves? So if, let's say that, the audit firm says, okay, this management, they don't have the highest amount of integrity, but we can do this audit. How do you think they protect themselves? Contracts and what other, right? So they lay things out. This is what we're going to do. This is what you're going to do. Okay? What other way, man? I'm thinking monetary. So that they have risk now. How can you compensate yourself for the risk? Right. It's audit fees. Right. So firms can price protect themselves, right? Because like, okay, we're increasing our risk. Think about it. If you are, you're going to pass that risk on to the client, and you pass that risk on to the client in terms of the fees that you charge that client. So when you have riskier clients, you can, an audit firm could probably charge that client more. And the reason that they can charge that client more is because if you have a riskier client, and when we talk about the audit risk model, we'll see the correlation. You have a riskier client, you have to step up your audit effort, right? So that means you're going to look at more documentation. You're going to go through a lot of things. You're not going to rely necessarily on all of the internal controls, which means you're going to do a lot more testing. That's greater audit effort. And that greater audit effort should translate to greater audit quality to help protect you against the risk of dealing with a client that might not be, as reputable.
Does that message by itself that the audits are raised speculative or something?
Well, not necessarily. I mean, you have to phrase it, be very diplomatic about it. You don't say, we think you're a liar, and we're going to charge you a lot of money, right? But I would imagine if you're addressing a situation like that, what you'd say to the client is that here's where the risks are. That's when we do the risk assessment. We feel that there's greater risk here, right? And as a result of that, we're going to have to, increase our audit effort, right? So you would phrase it in the way of and remember, the audit committee hires them, right? If you're a publicly held company, the audit committee has to hire you, and you could go to the audit committee and say, here's the concerns that we have. We have these concerns, and as a result of that, we have to increase our audit effort in the amount of time. We have to put in, we have to staff the job with more experienced personnel. And because we're staffing the job with more experienced personnel, that's going to cost more money. So I'm sure, partners are salespeople, right? So they know how to. You're definitely, because if a client thinks that you're already suspecting them, then what? Then they're not going to hire you, right? But if you're going through the audit committee wants to hire because they have responsibilities, right? So they want to hire an auditor who's going to be more diligent and not necessarily roll over. Okay, so that's the client acceptance and continuance. So we go through this whole engagement planning, business risk assessment, audit risk assessment for both new clients that we're accepting as well as continuing clients. Also, if it's a new client, it's probably been audited by another company, especially if it's certainly if it's a publicly held company, right? They've had prior auditors. So you're expected, the standards say that you have to communicate, or at least attempt to communicate with the predecessor auditor. The predecessor auditor has no responsibility to communicate with you, right? But you have to show, as the auditor, that you attempted to communicate with the predecessor auditor. Now, what you get out of the predecessor auditor might help you and it might not help you, right? Because there's still these concerns about client confidentiality. I don't know that a predecessor auditor is going to tell the current auditor, look, we got the heck out of here because, we don't trust these guys, or we were fired. They're not going to necessarily say that. So the amount of information that's really useful to you that the predecessor auditor provides might not be that great, but at least you want to, the standards require you to attempt to communicate with the predecessor auditor to find out information that might be useful. Obviously, we talked about independence and we talked about ethics over the last couple of weeks, and firms have to know before they're staffing that engagement, are there any issues, right? Does the partner have a spouse that works for that client? Or do you have any holdings? So you want to make sure that the audit team is independent, the engagement team is independent, and making sure that the team meets all of the independence and ethical standards. I talked about the engagement letter, which is a contract between the client and the auditor, which lays out what the auditor's responsibilities are versus what the client's responsibilities are. And then also if this is a client that you are rotating off, or the client has said to you this will be the last audit that you have to do, we're not going to really get into termination letters, but that's what a termination letter is. So, I talked about the fact that they have to attempt to communicate with the predecessor auditor, and that's just a matter of documenting that in your financial statements. Most audit firms expect to hear from new auditors, so it's common courtesy And some firms could be really forthcoming and other firms could be, and I guess it depends on the relationship that the firm had with the client, the nature of the situation that led to the termination of the auditor or the auditor and client parting ways. So again, it really varies in terms of what information the predecessor auditors will provide. What the new auditor is really looking for is they're going to ask questions about any disagreements that the predecessor auditor had with the client about accounting policies or how they were presenting information in the financial statements. Right? So basically what the new auditor wants to know, as the new auditor, you want to know, did this relationship end because you took a stand on how they should present something and they didn't like it and so they fired you? Because you'd want to know that going in. You want to know if management is very aggressive and if management is the type of management that, okay, we don't agree with what you want, we'll fire you. So you want to know about that. You want to know if there are things about fraud or any illegal activities that the client engaged in. And also why there was a change of auditors. Now, for publicly held companies, when they change auditors, they have to file an 8K, right? But the 8K really tells you nothing, right? It just tells you that they changed auditors. It doesn't tell you about what the reasons were for changing those auditors. So it's not very informative in that sense, right? It just informs the public that they have to file with the SEC, obviously, and that information is publicly available. So it doesn't really tell you much about why they changed. Just what led to the change, just the fact that they changed. So basically the auditor is communicating with the predecessor auditor to get a better understanding of any issues that arose that might give them, they're assessing risk, that might be increase the auditor's business risk. Again, the engagement letter, I'm not going to go, this slide kind of highlights what I've already said, that it's a contract, states what the audit objectives are, what the auditor's responsibilities are, what the client's responsibilities are. Okay. And so remember, when we talked about legal liability, if a client is going to sue the auditor for not performing something, right, or not adhering to, let's say, the deadline in terms of when they were supposed to issue the audited financial statements, they're probably going to link back to the audit engagement letter, right? Because those terms are going to be specified in the engagement letter. In terms of the approach to planning an audit engagement, we have basically 8 points or steps, right? The first is you accept the client, right? Once you accept the client, you perform your initial audit planning of the engagement, and that includes understanding what the client's business, understanding their business, understanding the industry. And when we work on the Toy Central case a little later in the class, you'll see the connection, right? So you have to understand, well, what kind of business is this client in? What's the industry like? Most firms, I think all of them really, most of their audit people specialize. They're going to be, they might have 1 or 2 industries that they work in, some of them 3, but for the most part, they're going to specialize in a particular industry. Why do you think that's important? Why would the auditor firm want their people to specialize? Right. So when you specialize, you have a better understanding of that industry. So you're going to be more, you're almost becoming like an expert, right? So you develop expertise about, so you're more knowledgeable about the accounting transactions, you're more knowledgeable about the economic factors that impact that industry, you're knowledgeable about what's going on in that industry, and then you're able, when you're looking, for example, if you're performing analytical procedures, you're kind of comparing your client's performance against industry benchmarks, you have a better sense of whether or not the auditor, your client, your audit client, is falling outside of that industry. Does something not make sense? Right? If the industry has experienced a significant downturn and your client is showing revenue through the roof, that might give you pause. Like, what is it that's caused, why is it that they're way up here and the industry is going in the opposite direction? right? You'd have to know that, right? Another thing is you assess what the client's business risk is. And that's you talking to management, again, knowing what the industry is, knowing what kinds of products the client has, where they are in their product cycle. So for instance, let's say you are a pharmaceutical company, you're auditing a pharmaceutical company. One of the things you're going to want to understand is, well, what kind of products do they have out there? Are there any products that they have that they patent, right? So that they really, because when you patent a product, you're out ahead of that industry, and you're probably, you're probably, you know, generating a lot of revenue from your patent products. You'd also want to know if you're let's say you're auditing a technology company, where's your client products in relation to the industry? Are they kind of falling behind? That there are new blockbuster products that are coming out that's going to put your client's product, make it obsolete, right? What do they have in the research and development pipeline? Why are those things important, do you think? Yes, Vivian. Right, so you want to know where are they, right? In the sense that if they're not developing products, especially if you're in technology, right? In the technology industry, you're going to quickly start losing revenue, right? You're going to start losing market share, right? Because if you're not aggressive, and then so the auditor wants, because that leads to what? If you're losing revenue or market share, there could be liquidity issues, right? That brings into the play are there some going concern issues, right? So, but the auditor wants to know that. Then you also want to know that what if it creates pressure on management? You know, a lot of times management's compensation contracts might be tied to their performance, how the company is performing in terms of market share, in terms of the share price or revenue growth, right? And so if your client is losing market share, you know, you're going to look at, okay, that might increase inherent risk in the sense that are they more willing or is there greater incentive for them to manage earnings? Right? So those are the kinds of things you're looking at those. Performing preliminary analytical procedures. And what analytical procedures are is a host of things. Analytical procedures consist of ratio analysis. It consists of comparing year 1 to year 2 to year 3, looking at how your audit client compares to the industry, how they're performing, looking at relationships between accounts. So for example, let's say the company's experiencing a decline in revenue, right? And accounts receivable, however, is increasing. There's a relationship there. What's that relationship? Does that make sense? What do you think? Sales revenue is going down, but accounts receivable is going up. Omar.
Prior to last year's sale, they probably received now for this year.
So let me think about this. So sales are going down, accounts receivable is going up. So you think that if accounts receivable is going up, then that would mean that they're not collecting, right? Right. So they're not collecting, and what does that mean when they're not collecting? What's your risk here? I'm sorry? Right, your allowance for doubtful accounts. So your concern as an auditor, the thing that's going to click for you when you see that, understanding that relationship, right? Sales are going down. So if sales are going down, I would expect to see a decline in accounts receivable. If I don't see a decrease in accounts receivable, that raises a red flag, right? Because if sales are going down, that means you're not making sales. So why should your accounts receivable increase? The only reason why your accounts receivable is going to increase, or possibly, is you're not collecting on what you did sell, right? And if you're not collecting, then I'm going to look at your allowance for doubtful accounts and try to determine, well, is this allowance for doubtful accounts even reasonable, right? So you want to look at those relationships. You want to look at the relationship between you know, things like inventory and inventory obsolescence, right? So if we see that inventory is increasing, but we're not buying any, you know, cost of goods sold, we're not buying any new inventory, but we see that numbers going up, that doesn't make sense. What does that tell you? Right, that inventory, there may be, we're looking at obsolete inventory. We're not moving our inventory, we're not selling. And so that means that, okay, now I have to look at whether or not there's increased obsolescence. So it's important to understand the relationship. Right? Also looking at industry trends. What is going on in the industry? As I pointed out before, what if your client's sales are going gangbusters and the industry is going in the opposite direction? What does that mean? What could be a possibility? Your client is moving up, the industry is going down. What could be a possibility? What would you look for to explain that? Your clients, their sales revenue is going up, however, you're seeing that the industry, on average, revenue is declining. Yes?
Yeah, maybe they have like an advantage, like a comparative advantage to maybe their industry, but maybe they're leading the way, even though like maybe they have like a patented technology.
There you go, right? You would say, okay, well, do they have patented technology? Did they come out with some blockbuster product that's making them rise? Is that easy enough to check? You would know that, right? Because you're understanding your client business. You know what products they have. You know what research and development they've been doing and whether or not that research and development has paid off. Did they just patent some new product? So then that's the relationship. Okay, then that makes sense. The reason that they're going gangbusters and the industry is declining is because they're far ahead on technological development. And you would know it. You would look for that relationship. If they didn't have that, right, if you said, wait a minute, this doesn't make sense. Why is their revenue going up and everyone else is going down? That's going to raise a red flag. You're going to look at sales revenue a lot closer. Right? Because one of the ways, and the researchers pointed this out, and if you look at just the anecdotal evidence, that companies manage earnings is revenue is the biggest way. Right? That's their first, you know, they're going to first look at how can they manage the revenue process to manage earnings. So performing analytical procedures. And the important thing that I want to point out about analytical procedures, all of these other things that you're doing here, you know, doing your initial audit planning, understanding the client's business as well as the industry, assessing what the client business risk is, the reason you're doing those things is they help you form a basis, an understanding. Because analytical procedures are useless if you do not have a good foundation going in to base your expectations on. Right? Because what analytical procedures are doing is saying, hey, I have some expectations about how something should work. I have some expectations about the relationship between sales and accounts receivable, right? Or between inventory and inventory obsolescence, between my audit client and the industry. I have expectations. And the only thing you can do is assess, take that information and apply it against your expectations and see, does it make sense? If we're conducting a ratio analysis, that's a simple mathematical calculation, right? If I'm looking at current assets, current liabilities, right? I'm looking at the current ratio. Simple, I perform that simple calculation. What does that tell me on its face? You guys have done ratio analysis? So what does it tell me when I look at my current ratio? So I perform, because we can all divide. Current assets divided by current liabilities. What does that tell me? When I get that number, what does that number tell me by itself? Do I take that to mean it tells me nothing? Fine.
It tells me how, if I'm able to pay off my debt, sort of like my liquidity.
Okay, so it tells you something about liquidity, right? It tells you about the liquidity of the company. Are you generating enough? But is that enough for you to say, oh, this company has no going concern issues? Is that enough? No, right? It's going to be all these other things, right? So it's just saying to you, when you perform ratio analysis, you have expectations. So you're going to say, okay, this is trending in the right way. It doesn't mean I stop here and I do no additional work. I still have to do some additional work. If you had some expectations about, industries going down, they're not generating as many sales as they were. Their accounts receivable is increasing, so they're not collecting. So if that's going on and you see that their ratio says otherwise, those two things don't make sense. But you have an expectation, right? And you're going to evaluate the outcome of those ratios against your expectations. So that's why it's so important to develop, to perform the necessary procedures to make sure you have sound expectations. Yes, Jimmy. So I'm thinking about your accounts receivable, trade accounts receivable. So if your trade account, because your trade accounts receivable really is tied not so much to your investing, right, but it's tied to your sales, right? So your revenue. If you're generating revenue, right, and we're on an accrual basis, you're generating revenue, you're going to debit accounts receivable, credit cash. I'm sorry, credit revenue, sales revenue. So once we collect it, so we expect to see that accounts receivable number kind of go down, or in a 30-day period, let's say, we expect to see that they've collected on that. So if your revenue is going down, but your receivables are going up, I think that is more indicative of you not collecting. I'm not sure I see the connection to investments. If you're talking about receivables in general, you could be right. Right, but but the trade receivables, when I talk about accounts receivable, I'm thinking trade receivables, because that's tied to your selling process, right? Your sales process. Did I misunderstand what you were trying to get at?
Close
Okay. All right. Okay, so your analytical procedures, we're going to talk about materiality and audit risk next week. And inherent. So the inherent risk is a component of the audit risk model. And your inherent risk is really determined by these procedures here: understanding the client's business, assessing what their business risk is. And your inherent risk is kind of linked to what's the susceptibility of a misstatement in this account, right? So it's looking at the susceptibility of account to a material misstatement. So we'll talk about that more. But again, this is a part of the planning process. You have to set your materiality. And materiality, as we said much earlier at the beginning of the semester, was what would change the decision process or impact the decision process for a reasonable user of the financial statement. Right? And that's how an auditor has to assess it. So we'll talk more about the qualitative aspects of materiality as well as the quantitative aspects of materiality next week. And then this idea of the audit risk model. And what the audit risk model, basically, audit risk is, how many people know what audit risk is? Heard the term before. Have you heard the term prior? Right. So the audit risk, right, is the auditor's risk. Right? And it's the risk that they issue an incorrect opinion. Right? And the bigger risk to them is that they issue an unqualified audit opinion when in fact they're material misstatements. Right? Because if they're material misstatements in the financial statements, that would suggest that they issue a qualified or an adverse opinion. So their greatest risk is when they issue a clean, unqualified audit opinion when in fact there are material misstatements. And so what an auditor is going to do with the audit risk model is designed at how does an auditor try to mitigate that or to reduce that risk that they will issue an incorrect audit opinion. So we'll talk more about that next week. And then understanding internal controls and assessing internal control risk, also a component of the audit risk model. And what we'll talk about when we talk about the audit risk model, the auditor can only control audit risk. They have no control over inherent risk, and they have no control over control risk. Right? That is, they only assess that risk based on client information. So based on how well they go through this audit planning process, right, is going to be directly related with how well they assess inherent risk and control risk. And I'll go into detail with that more. The other thing that they're doing in the planning stage is gathering information about fraud risk, which is very different from fraud. They're not identifying fraud, they're identifying the risk of fraud. So, and we'll talk about that in a few weeks when we talk about fraud, but they're identifying where, based on these procedures that I perform, based on my assessment of control risk and inherent risk, where is the risk for fraud? Where might fraud be perpetrated in this? So let's say, for example, the company has lax internal controls, right? They don't, they just don't really, they don't have good controls in place, and where they do have controls, they're not following. The auditor would probably determine that that increases the risk of fraud. If there's a lack of segregation of duties, right, then that increases the risk of fraud. So that's what the auditor is doing in terms of assessing fraud risk. They're not saying we're going to find fraud. We're just saying the fact that these things exist increases the risk of fraud. And then based on that, they develop their overall audit plan and their audit program. And their audit plan and their audit program is their audit approach. Right? My plan is my approach. So, for example, if I determine that, this is a solid client, they're really concerned about issuing quality financial statements. So in other words, as an auditor, I'm not concerned about the integrity of the client. I feel that they have high integrity. They set this tone at the top that is very focused on quality, very focused on internal controls. And so the auditor then says, in controls, they have an excellent control environment. I can rely on internal controls. So in those two, in that simplified case, control risk is low, inherent risk is low, and because those two things are low, then I can say there's the chance of there being a material misstatement is low. And then my audit approach is to rely on internal controls, so I'm going to test internal controls, and then I'm going to reduce my substantive testing or the detailed testing that I do. Right? Because I can rely on internal controls, I can reduce that. So my audit approach is to rely on internal controls, reduce my substantive testing in order to keep my audit risk low. And that's what I mean by and so the audit program will be developed based on that audit approach. But we'll talk more about it when we talk about the audit risk model, how that translates to the audit approach. So as I said, understanding the client's business and industry is looking at both the industry and the external environment. So what's going on? Like what is going on in the larger economic picture that impacts my client's industry? So we saw, for example, with the housing crisis, right? The fact that people were losing, underwater on their mortgages and those types of things. We saw that that could have a rippling effect, right? You didn't see in the buildings, right? So because people are stuck with these mortgages, they're underwater, they can't sell their house, so they're not moving. Or they're foreclosing, right? They're not moving. So if they're not moving, then houses aren't selling. Builders are no longer building because why are you going to build? There's no demand, right? So that if you're auditing Home Depot, that has an impact on Home Depot quite possibly because there's not a whole bunch of building going on. So what's going on in the larger market? We saw things like, I'm just trying to think of some of the things with the crisis. Oh, another thing was lenders weren't lending money. They were making, they were tighter, right? You had to have, let's say if you were a consumer, you would have to have like an astronomically high credit score to qualify for mortgages in some cases or qualify for loans. That inhibited your ability, right, to borrow. Once your ability to borrow was limited, you're not, you wouldn't go out and borrow money because you're having a hard time, and so you're not you're not putting money into the economy, and so we see the rippling effects of that. So you want to look at what kinds of things we saw with the auto industry, right? And one of the big reasons for, or one of the big objectives obviously was to get to not let the auto industry fail, because by having the auto industry fail, it meant a whole lot, it had a rippling effect on other businesses, right? That was the argument. That it's not just that General Motors would go out of business, but all of the companies that supplied General Motors, parts, they would go out of business, right? So there's a rippling effect. So you look at, so as an auditor, you're going to look at what is the larger macroeconomics that are going on, and how does that impact my client, and how does that impact the industry? Understanding what the client's business operations and processes are. So auditors audit on this business process approach, this cycle approach. You have the sales and revenue cycle, you have the acquisition and disbursement cycle, the inventory cycle, the financing cycle, and you look at, the auditors are going to look at, and we'll cover this as we go through auditing revenue and auditing acquisitions. Those are the two we're going to look at, right? The auditors are like, well, what are the main accounts there, and what are the relationships in those accounts? And where's the inherent risk for all of those, for each of those, the major accounts in that cycle? What are the control risks associated with that cycle? Tone at the top. That's what we mean by management and governance, right? What we're concerned with here is integrity. Like, what message is management sending? We saw with the case that we did on Wednesday, the Rutgers ethical dilemma. Company has a code of ethics. Well, do they have a hotline? How do they enforce it? Is it just code of ethics in form, right? Meaning that they have something on paper, but there's no substance behind it. Same thing with the audit committee, the board of directors. Do we have an audit committee in substance, or do we have an audit committee in form? How much is the audit committee really, does it have teeth, right? Does it give the auditor some bargaining power? Can the auditor look at and view the audit committee as an ally when they run across situations? So these are the kinds of things they evaluate. Also looking at what management's objectives and strategies are, as well as how they measure their performance. Management measures its performance. And so, again, what we're talking about here when we're collecting this information is sufficient competent evidence. Remember the second standard of field work. SOX also requires that managers certify that they have an effective system of internal controls in place. And it's the management's responsibility to develop a system of internal controls. Auditors are just auditing and evaluating that system of internal controls. I already talked about analytical procedures. You have ratios, understanding the client's business and their industry. One of the other things that you're doing that's very key in the planning stage is you're going to assess the company's ability to continue as a going concern. Because when we look at the audit opinion, in the audit opinion, you're giving is that this company it's implied that this company is going to be able to continue in the next operating cycle, right? In the foreseeable, not 10 years from now, 5 years from now, but next year. They can continue for another year, right? And so if the auditor has concerns about that, and then they're going to issue what we call a going concern opinion. And we'll talk more about that when we talk about audit reports. But that's not something that you get to the end of the audit and you're evaluating. You're going to know this going forward at the beginning. And what you're doing at the point once you've identified it in your planning is you're gathering evidence to be able to support whether or not the client can continue as a going concern or not, right? Because that's going to affect your opinion. I talked about the different analytical procedures, but industry data, looking at prior period data, comparing that to the current year, looking at the client's determined expected results, right? Because the client's doing the same thing. They have budgets. They're evaluating their performance against their own benchmarks. They're evaluating their performance against maybe analysts, forecasts, or industry performance. The auditor has their own expectations, which I talked about, right? Because they're evaluating the client, evaluating the industry, looking at what the client business risks are, looking at prior periods and comparing that and forming expectations. And then another thing, because we are in this environment where we can get data pretty easily, auditors are also going to look at non-financial data. Right? So they're not going to just focus on the financial data. They're going to look at non-financial data that would give them some inclination or some insight into the financial performance of the company, what might impact the company. Okay, any questions about planning before we move forward? So we're going to keep coming back to this idea of planning. The next thing that I want to talk about would be my favorite subject. No, I'm not, I'm lying. It's not my favorite subject. And it's not likely to be yours either, based on prior history. But it's important. Assertions. So notice my little cartoon character, because that's how you're going to be when you take the exam and you see assertions on there. Okay. So management assertions, right? Management assertions are the statements that management makes about the financial statements or the accounts in the financial statements. Remember, management is responsible for the financial statements. So they're making these assertions. So for example, they'll make an assertion that revenue is complete. So everything that should be in there is in there. Right? They'll make an assertion about the valuation of allowance for doubtful accounts or accounts receivable. So they're making an assertion that we have value, we've considered the allowance for doubtful accounts using a reasonable method to determine the allowance for doubtful accounts, and therefore accounts receivable is valued correctly. Right? So they're making the assertions. Remember, they're management's financial statements, not the auditor's financial statements. And related to that, auditors are going to use those assertions and test to guide their audit tests. Right? They're testing those assertions. They're gathering evidence about the assertions that management's making about the financial statements. So their audit procedures are developed around these assertions that management makes about the financial statements. And basically, what we're concerned about, the financial statements should be fair, right? They should fairly represent the economic transactions that the company engaged in, right? And that's what the auditor is gathering information about. Are they in accordance with the applicable financial standards, such as in our case, generally accepted accounting principles? So this is not from your text. It's just I like the way that this is presented. But it's how did the auditor develop their audit objectives? And so first you understand the objectives and responsibilities for the audit. So we lay that out in the audit engagement planning, right? But I mean, you're performing an audit of financial statements. Your objective is to gather evidence to be able to support your opinion, whatever that opinion is, whether it's a clean opinion or not, right? But you're gathering evidence to support that opinion. Then you're going to divide the financial statements into cycles. And that's what I talked about when I talked about the sales and revenue cycle versus the acquisition cycle versus the financing cycle. Understanding what happens in each of those cycles. So for example, in the sales and revenue cycle, what's the objective there? I'm selling product, selling a service, and I expect to collect on that. I take the money that I collect on that, reinvest it in the business, buy more product, hire more people, and continue to sell, right? Sell, I'm trying to grow my revenue so I can grow my profit. Right? So what are the different cycles? So what's important in the revenue cycle? Obviously revenue and collections. What other accounts are in there? Allowance for doubtful accounts, sales returns and allowance, bad debt expense. Those are all accounts that are sold, and cash, obviously, associated with the sales and revenue cycle. So an auditor, that's the reason you want to break down the financial statements into these cycles and look at the accounts that are impacted by these cycles and the relationship. No management assertions about the various accounts in the financial statements. So management, the assertions that I'm going to tell you are the same. It doesn't matter what cycle you're in. Right? You are basically making the same assertions. from an audit perspective, though, how you go about the evidence that you collect to test that assertion is going to be different based on the cycle that you're in, right? Because if management is making an assertion about sales, you're going to want some information or collect audit evidence that tells you. So let's say, for example, management makes the assertion about sales, that all sales that should be recorded have been recorded. So they're saying all sales, so basically that for everything I sold, it's recorded in my sales journal. So the auditor is going to get evidence that would support a sale. What evidence supports a sale? Let's say we're in selling a consumer product, a consumer products business. So we're going to look, the auditor is going to look for evidence that supports a sale occurred, and that would be that the goods were shipped. So the auditor is going to look at shipping documents, right? So that's going to tell me if I ship the goods, then the sale occurred. That's a proxy that we use in GAAP. GAAP recognizes that. So that would be the type of audit evidence. If the auditor makes that same assertion about expenses, about liabilities, all expenses that should be recorded have been recorded. So if the auditor is looking to determine that, for example, that the payroll account, so all payroll expenses that were actually incurred, they're reflected in my payroll expense account in the income statement. So what would they look for? They're going to look for evidence. They're going to look for checks, payroll checks, or payroll documents showing that a person actually, not checks, but payroll documents like time cards, for example, right? That they showed, approved time cards that showed that the employees who worked, right? So I incurred the expense because I have this time card that says that they worked, that those expenses are reflected in the payroll general ledger. The payroll subledger. Right. So the assertion is the same, but the evidence that the auditor is going to collect is going to be different. So that's the key thing. Assertions don't change. Know what the general audit objectives are for classes of transactions, accounts, and disclosures. So the audit objectives, management makes assertions, auditors audit to those assertions. They gather evidence about that, and I'll show that in a minute. When we talk about classes of transactions versus accounts versus disclosures, so we have three types of assertions. So I want you to take a moment and look at the assertions in your text, if you have your text, on page 11 in your text. It's Exhibit 1.4. Okay. So if you are looking at Exhibit 1.4 in your text, you'll see that there are PCLB assertions and there are ASB assertions. So obviously the PCLB assertions are for publicly held companies and ASB assertions are for non-public companies. However, if you look at the assertions, they're the same. The difference between the ASB assertions and the PCLB assertions is that the ASB assertions are much more detailed. The PCLB kind of summarizes, though, their assertions. So, for our purposes in this class, regardless of whether we're talking about a publicly held company or a non-public company, we're going to study the ASB assertions. I want you to understand the ASB assertions. We're going to always go, because there's no difference. It's just that the PCLB summarizes the assertion. The objectives don't change. The reason I want you to have to learn the more detailed assertions is because it's easier to develop an understanding of the assertions by using the ASB assertions because they break it out to so much more detail. And so if you look at the ASB assertions, so anytime I talk about assertions, you should automatically go to the ASB assertions, unless I say otherwise. Okay. So if you look at the ASB assertions, you'll see that across the top, the ASB assertions are broken out into assertions about events and transactions, assertions about account balances, and then assertions about presentation and footnote disclosure. And that's how you want to learn the assertions, based on those categories. Assertions about events and transactions are generally assertions about things that are flowing through the income statement, or transactions or events that are flowing through the income statement, right? Because think about it. What does your income statement represent? This is taking back to 101, intro accounting. So not really the position. What are you record in your income statement? Let me put it that way. Right, sales. And what is the sale? Right, it's revenue, but how's that revenue generated? Right, you're recognizing your revenue and expenses, and how are they generated? Because, Omar. Well, aside from that, right, I mean, we do look at the sales and say, okay, we look at the income statement and say, okay, we're looking at whether or not they have a profit or a net loss. But I'm trying to decompose this. So let's take, how does a sale originate? Let's do that. Through a transaction. What did we just call this assertion? Assertion about events and transactions. That's why I'm saying that when you think about assertions about events and transactions, you're thinking about the income statement. You're thinking about what flows through my income statement. Management's making assertions about things that are flowing through the income statement, essentially, generally, right? Your income statement captures the transactions, the economic transactions that the company engages in during the course of the year, right? For that company's fiscal year end. That's what so it shows the accumulation of all the sales, all of the expenses that the company, that summarizes the transactions that the company engaged in for that year, right? So that's why so generally you're looking at transactions. When you're looking at transactions, you're looking at what flows through your income statement. Those assertions deal with that. Then assertions about account balances, and that really goes to what you're saying, Ricardo, is that's the company's position, right? You can say, when you look at the balance sheet, what does the balance sheet tell you? Think about the accounts in the balance sheet. What does that tell you? Yes, John. On that particular day, year end, right? 12/31. That's the company's finance. The income statement can't tell you that. The income statement only says that this is what the company did for this year, for the year ended December 31st, 2013. This is what the company did. The balance sheet says this is where the company stands as of that date. This is the position. So that's the account balance. Think about it. Let's just go back to your intro accounting. What do we do to the income statement every year in closing? We close it how? Right. Your income summary, it goes in, you close out sales, net income to retained earnings, right? So the income statement, so every year you start anew, right? There's no carry forward from the income statement. You don't add on revenue from the prior year. It's zero when the new year starts. Your account balances, on the other hand, represents an accumulation of your company's operations, right? From the inception of the company. Cash, accounts receivable. Yes, there's ins and outs, debits and credits, but that's what it represents, right? So your assertions about your account balances, right, are going to be primarily the balance sheet accounts, like accounts receivable, cash. And then your assertions about your presentation and disclosure deals with how information is presented in the financial statements. So don't only think about footnotes. Presentation and disclosure, because your financial statements represent the income statement, the balance sheet, cash flow, right, as well as footnotes. what does GAAP tell us? GAAP says that in your balance sheet, you have to show assets, liabilities, and equity separately. Right? You don't just get one number or two numbers, right? That's presentation. It also says that you're supposed to identify current assets versus total assets, versus long-term assets, right? So the things that should be in current assets are cash, accounts receivable, inventory. We have a definition of current assets. We have a definition of current liabilities, right? So that's what we talk about when we talk about presentation. So it covers not just in footnotes. Presentation and disclosure covers the footnotes as well as the actual financial statements, how things are presented in the financial statements. So that's what we mean by the general. And then your specific audit objectives would be the auditor's audit procedure. What are they trying to prove, right? What are they trying to get evidence about? So with revenue, they're trying to get evidence that revenue is, that everything that should be in revenue is in revenue. What's in there should be there. So it's a valid transaction, right? So that would be an example of what the auditor's specific audit objective is with relation to revenue or liabilities, that all liabilities have been appropriately reflected in the balance sheet. Sarbanes-Oxley, and I'm going to get to assertions in a moment, but Sarbanes-Oxley basically says management has responsibility for the financial statements. What changed is that management has to sign off, right? We didn't have that before. It was implied. Everyone knows it. But Sarbanes-Oxley is like, look, you cannot say as the CFO or CEO that, I didn't know they were doing that. It's your responsibility to them. And you know what? We're going to make you sign it. You have to sign that. Why do you think signatures are important? Why are signatures important? Right. It holds you accountable and liable. Right? You are accountable. Which is one of, which is one of the reasons a lot of firms, the PCAOB is kind of throwing this out there, and I'm not sure where they are in this process, but looking at having audit partners actually sign the financial statements with their name. Not just the firm's name, but that audit partner's name as well. Because they figure people like, ooh, wait a minute, I can't hide behind KPMG or PwC. My name is out there. Like now, all of a sudden, my name. Right now, you don't know. You pick up financial statements, you only know that what firm audited. You don't know anything about the partner or the engagement team. And so, that's one of the things that the PCAOB is looking to mandate, but I don't know where they are in the process or if it will. Obviously, firms don't want that to happen. They're uncomfortable with that. So anyway, management's responsibility, basically they've read the financial statements. They are not aware of any false or misleading statements or any omitted disclosures. They believe that the financial statements present an accurate picture of the company's financial position. And that's basically what management's responsible for, right? And now Sarbanes-Oxley is saying, you need to certify that along with the financial statements. The auditor's responsibility is to identify whether there are any material versus immaterial adjustments or misstatements, right? So if an account is off by $100, it's not going to be material, right? That's immaterial. I mean, the auditor is not going to qualify the financial statements. But if it's material, it could lead to a qualification in the financial statements, and we'll talk about what leads to that. They provide reasonable assurance, so think about the wording and terminology we use in the audit report. They provide reasonable assurance. Why? Because they're not looking at 100% of the items, so they can't provide absolute assurance. They are going to identify errors versus fraud. They have to distinguish between errors versus fraud. An error is an honest human error, mistake. No malice intended. Right? A client wasn't trying to mislead. They just made a mistake. Versus fraudulent financial reporting, right, where there is malice, where you are trying to mislead. And when we talk about fraud, we'll talk more about that. And we already talked about professional skepticism, so I'm not going to go into that anymore, right? But you have to conduct the audit with this mindset, a questioning mindset, a critical assessment of the professional skepticism. So with respect to management assertions are directly tied to GAAP, and I'll go into that when I give some examples as I talk about it. As I said, it's what management says, or statements that management makes about the financial statements. And I already talked about the different classes of assertions: transactions and events, account balance, and presentation and disclosure. And the auditor is basically obtaining assurances for all of these assertions and different transactions. When I talk about, the book really doesn't go into this as much, so I want to be very clear about this. The auditor's transaction-related audit objective is basically the auditor takes management assertions and they're going to identify what audit objective do I have to test this? Like, what is my objective in testing this assertion? Management's asserting that all sales that should be recorded have been recorded. My audit objective is to determine that they're complete, the sales are complete. Management's making assertions that there are no fraudulent sales, right? That sales were only recorded for things that actually happened. And my objective is to, as an auditor, is that there are no fraudulent sales there, or there are no sales to non-customers. And we'll talk about that more. So it's closely related to management's assertions, right? It's the framework. Management's assertions are the audit objectives are based on management assertions. It's the framework, the transaction, or the audit objectives are the framework that the auditors use to audit the financial statements. So remember, the auditor is the objective is to obtain sufficient, appropriate audit evidence to support management's assertions, and obviously to support their opinion. So let's talk about the assertion. So if you can follow along, I've just kind of summarized what's in exhibit on page 11, which lays out the assertion, AFD assertions, right? So management assertions about classes of transactions and some of them will overlap, but some of them are distinct. So occurrence. An occurrence just basically says the recorded transactions in the financial statements actually occurred. They're valid. So for example, if I'm looking at sales revenue as the auditor and I'm testing occurrence, my objective is, yes, I want to see that they're valid sales. What evidence am I going to get to see that they're valid sales? What do you think? How do we know under GAAP? Because remember, the assertions are tied to GAAP. So what is it in GAAP that tells us the sale is valid? What's the criteria, Omar?
Sales value, there was a transaction between both parties.
Right, so an arm's length transaction, right? So we wouldn't want, so would we consider revenue from a related party? What happens to related party transactions? Do we not record them? At year end, what do we do with related party transactions? Remember that consolidation? What do we do in consolidations when you're taking? Right. There's a reason, right? Because revenue, that's what Omar is saying, the revenue that we're recording should not be, it should only be arm's length transactions. Related party transactions are not considered arm's length, right? We're not, imagine if a company boosted their revenue by including related party transactions. Is that really, it can't happen, right? Right, you're double dipping. So, we would want, as an auditor, we want to make sure there are no related party transactions in there, right? We wanted this arm's length transaction. Right, GAAP says, right, that there has to be, some evidence that transaction it occurred. One thing that we look at is did we earn it, right? Was it earned? And we might look at testing that it was earned by looking at shipping documents, right? Because if we shipped it, then that is pretty strong evidence that we earned it. I mean, we're going to look at other things, but we would maybe start with a selection of shipping documents. So we want to say that we want to look at that it's a valid transaction, that it actually occurred. The other thing with transactions we're going to look at is completeness. All transactions that should be recorded have been recorded. So the difference between occurrence and completeness, occurrence is looking for overstatement. So when an auditor is testing occurrence, they're testing to ensure that revenue is not overstated, right? Because they want to make sure that there are no related party transactions in there, for example, right? Because that would overstate revenue. Completeness tests for understatement, right? That something that should be recorded is missed. So for example, if the client's internal controls were not very effective, they might not record, they might, sometimes forget to record revenue when it's shipped. So what do you think the greatest risk is between those two? What creates the greatest audit risk? Right, overstated. Not that there's no risk with understated, but if companies are going to play around, they're not going to reduce their revenue, right? They're going to try to increase their revenue, right? So that's the greatest risk. So overstatement, occurrence test, overstatement, completeness test, the risk of understatement. Then just keeping up accuracy, basically transactions have been recorded at the correct amount. They've been classified appropriately, and that, so for other words, trade receivables reflect revenue reflects revenue from third parties and not related parties. Cutoff that is recorded in the proper period. So for example, if we made a sale or processed the customer order on December 31st, but we didn't ship those goods to the customer until January 3rd, that revenue should not be reflected as of 12/31 because we didn't ship the goods, so we have no right to record the revenue. So that's what cutoff is. So when we talk about, so let's look at the general transaction-related audit of. So the auditor, again, here's what management is asserting. Management assertions about these transactions. The auditor for occurrence wants to know that the transaction exists. So again, recorded sales are for shipments made to non-fictitious customers. Because if you create a customer, if it's not a real customer, you don't have a real sale. If I sold it, sent it to some warehouse that I'm just kind of stashing it there until after year end, so I can say that I shipped something, there's no customer. That's not a sale. That's fraud. Right? That's not a sale. So you want to make sure that the sales are being recorded for shipments made to non-fictitious customers. Right? So one way that the auditor would do that, right, is that they would start with the sales journal, right? Because here you're concerned about overstatement. So the auditor would start with the sales journal, which lists all of their sales transactions for the period, select a sample of sales transactions, and trace those transactions to a shipping document. First, they would make sure that these are valid customers. So they would test to make sure it's a valid customer by, comparing it to an approved customer list, right, that is made to a valid customer, and that it was actually shipped as of 12/31. It occurred on or before 12/31, right? Now we're going to test for completeness. The auditor is concerned that existing transactions are recorded. So everything that should be recorded have been recorded. the existing sales transactions are recorded, so the auditor is going to go the other way because they're concerned about understatement with completeness. So they're going to go and select a sample of shipping documents and trace those back to the sales journal. You see the difference? Does that make sense? Right. So with the completeness, because you're concerned about understatement, the auditor is going to start with a selection of shipping documents. So they're going to go through through the documents that has all of the shipping documents. I'm sorry, the journal that has all the shipping documents, or listing of all the shipping documents. They're going to select a sample of shipping documents and tie those back to the sales journal, right? Because and this is assuming controls are effective and we can rely on internal controls. So if we say we can rely on internal controls and that the client has really good procedures to ensure that a shipping document is only recorded when an item has been shipped, right? So when that item has been shipped, that says to me as an auditor, we've earned it. GAAP, we've earned it because we shipped it. That sale has been earned. I want to know that that item that went out the door, that we recorded a sale for that item. So I'm going to go from the shipping document, a sample of shipping documents, back to the sales journal and tie those back to the sales journal. That tells me that it's complete. The other way, I'm starting with the sales journal because what my concern is overstatement. I want to ensure that everything that has been recorded as a sale is actually a sale. It's valid. So I would have to start with the sales journal and make sure that there's a corresponding shipping document to support that sale that's recorded in the sales journal. Make sense? Okay. So that's how we're relating management assertions to audit objectives to audit procedures. Right? And then quickly go to the other. Accuracy, recorded transactions are stated at the correct amount. So you would look at the auditor could test that the sales are for amounts that are correctly billed. So for example, if I sell to customer X at a rate of, $100 an item, I want to make sure that my invoice properly reflects that I've billed this customer for $100 an item, right? That I've billed them correctly, and then that amount rolls up into the sales journal at the correct amount. The audit objectives also related to accuracy is posting and summarization so that they are posted to the correct account and they're posted and summarized appropriately in the master file. Classification, again, transactions are properly classified. In other words, I'm only posting in the revenue account revenue from third parties or customers and not related to party transactions. And then, as I said, cut off, my objective is timing, that the sales are recorded on the correct dates. Again, typically what we would do in this case is select a sample of transactions before year end, a sample of transactions after year end, right around that cutoff date, or 12 days, maybe 3 days before year end, 3 days after year end, and examine those transactions to make sure that they're reflected in the correct period. So again, that's how we are going to link start with management assertions, develop our objectives to test those assertions, and develop our audit procedures to meet those objectives.